All right, today we're going to do a deep dive into a professional-grade global macro brief. This is the kind of high-level analysis that lands on institutional trading desks. Our goal is to decode it, to give you a really clear and concise health check on the entire market.
So here's how we'll break it down. First, a market diagnosis. Then we'll look at the core drivers behind it all. After that, we'll read the reactions in other assets, connect all the dots, and finish up with the trader's playbook.
So first up, what is the overall feeling in the market right now? Well, the best way to describe it is a state of partial relief. You've got these two big competing risks that are really wrestling for control, and it's creating this very specific tension.
On one hand, you have what's called the war premium. That's the extra risk priced into the market because of geopolitical conflict. The good news is that's starting to decrease. It's compressing. But on the other hand, the policy risk premium is still very high. This is the big one. It's the fear that central banks are going to make a mistake, keeping interest rates too high for too long.
So what does that mean for us? Well, it means the extreme panic and volatility we saw recently has calmed down a bit. But we're not out of the woods. We've just entered a new phase, a very choppy, headline-driven market where every piece of news can cause a major swing.
Okay, to really understand this choppy market, we've got to watch its two most critical vital signs. Just think of these as the first two dominoes in a very long chain. Everything else that happens starts right here.
And the first domino, the primary macro driver, is Brent crude oil. Right now, the spot price is $93.40 a barrel. You could argue this is the single most important number for the market today.
So this price puts oil in what we can call a stabilization zone. We've moved down from that recent shock level of $110, which is a very good thing, but we're still in a range where any headline about energy can send ripples through everything. The market's calmer, but it's definitely listening.
Now for the second key domino, the yield on the U.S. 10-year Treasury note. It's sitting at 4.27%. This number isn't just about the cost of money. It's a reflection of a very specific fear in the market.
And that fear, again, is policy risk. Let's be clear about what this is. It's the danger that central banks, in their mission to fight inflation, will just keep policy too tight for too long, especially when the economy is already stressed from high energy prices. That 4.27% yield, that's the market telling us it's worried about exactly that scenario.
So we have our two core drivers, oil and Treasury yields. Now, let's take a look at the ripple effects. How are these two big forces impacting other major assets all around the world?
Let's start with the US dollar index, the DXY. It's at 99.1. The easiest way to think about this is as a global liquidity gauge. It tells us how much stress there is in the system when it comes to getting US dollars. At this level, the dollar is in a pretty neutral zone, and that's important. It tells us that even with all the tension, we are not in a full-blown financial crisis. There isn't a desperate global scramble for dollars, and that's a key sign of stability.
Okay, next up is gold, trading at $4,550. And right now, gold is playing a really interesting and very unique role in this market.
It's actually functioning as a dual hedge. What does that mean? It means it's protecting investors from two different things at the exact same time. One, a flare-up in geopolitical tensions, and two, a potential policy mistake from the central banks. It's like a two-for-one safety net.
So what about the stock market? Well, the S&P 500 is finding its footing, but it's a conditional stability. It can hold its ground as long as our two core drivers play nice. Specifically, Brent oil has to stay below $105 a barrel, and that 10-year yield cannot go above 4.5%. If either of those levels break, stocks are going to be in trouble.
And finally, let's take a quick look at a newer asset class, Bitcoin, which is trading at $68,500.
Now, Bitcoin's stability right here is fascinating because it's acting like a real-time barometer for market liquidity and risk appetite. The fact that it's holding steady in this neutral range tells us that the financial plumbing is still working okay. Investors are not yet running for the exits in a full-on panic. Okay, so we've looked at all the individual pieces of the puzzle. Now, let's put them together. Let's connect the dots and see how a single piece of news can set off a very predictable chain reaction across all of these markets.
Here's how the chain reaction works. It all starts with a geopolitical headline. From there, oil prices react. That causes inflation expectations to shift, which in turn makes Treasury yields drift. Then the US dollar moves. Through all of this, gold and crypto tend to hold their ground. And then finally, the stock market can react, usually pretty cautiously. It's a clear, logical sequence of events.
So the big question is, how does an informed investor
actually use all of this?
Well, it all comes down to knowing the key levels, the trigger points that signal a real shift in the market's mood. Let's pull up the playbook.
Think of this as your cheat sheet, your decision matrix. It lays out the specific thresholds for our key assets. Look at oil. Above 110 is a big risk-off shock. Below 95, that's relief. For the 10-year yield, anything above 4.5% puts serious pressure on stocks. And for Bitcoin, a move above 70,000 signals that risk appetite is healthy. Each asset has its own if-then trigger points that flip the market from one regime to another.
And this all boils down to one core rule. When the chain aligns, meaning oil is down and yields are down, that's a green light to lean into riskier assets like stocks. But when that chain starts to break apart or get jumbled, that's your signal to reduce exposure. It's that simple. The market is trading these connected premiums, not just isolated numbers.
Which really leaves us with a final thought to chew on. In this choppy, headline-driven market we're in, it's so easy to get fixated on the initial news, the first domino to fall. But the real story isn't the headline itself, it's the chain reaction that it kicks off. So the question is, are you watching that chain reaction, or are you just watching the initial news?